One of the things that came out of sort of the questionnaires for folks here was the human capital, and I'd like you each to comment from your perspective on where you view that now. How have you been able to maintain the talent? Have you had to go through a lot of turnover, and if so, do you still feel like you're in a period of retrenchment, or are you viewing this opportunistically as a time to add talent? But maybe we'll start with you, Steve.
I think there was an initial focus of wanting to keep everybody together, and so we all kind of tightened our belts. Of course, raises were modest, and partners took a lot less income, and we were able to really keep our people together. The other side of that is that there weren't a ton of alternatives for staff. So I think a lot of people went from maybe thinking about what's the best opportunity out there to being really grateful that they had a job. So I think if you had the good fortune to raise a lot of assets, it's a great time to hire and upgrade people. But really, I've just been glad that we could keep our people, and that's been really, that's really been the major focus.
Yeah. Jordan.
Someone said to me recently that having a job's a new status symbol. So I think that there's a lot to be said for taking advantage of a bad job market as being a retention mechanism. We have been in a retrenching posture, both as an organization and individually. And by that I mean, as the performance fee was turned off and firms were underwater, you had to do the same amount, if not more, with less. So our approach to that was to thoughtfully reduce the workforce, which is what HR tells me I'm supposed to say when you fire people. And that's a tricky thing to do because you can't in any way cut into the muscle of the organization and impair your functionality. So as an organization, we first sought to circle the wagons and focus on the things we're good at and focus less on things we thought we may be good at, but we weren't sure. And then with fewer people, we were faced with the challenge, how do you do the same amount, if not more, with the smaller workforce? So the way we tackled that is we retained people who could wear multiple hats. So if you had someone who may be the world's greatest at function X, and I'm talking about the non-investment side here, at function X, but you had another person who could do 2 or 3 things, perhaps 80% as well, those were the people that we retained. So you find people who were in middle management and senior to middle management now doing more junior tasks, as well as doing what they used to do, which was managing the people who did junior tasks. So there's sort of a retrenchment, if you will, in people's personal careers, as we've all had to do more with less.
Yeah. Bob?
Most of our compensation is formulaic. We give a base salary and then a bonus based on how the performance of the group did, and then we have another equity ownership based on how the company did. So other than in our sort of more staff jobs like sales and CFO and accounting, everybody knows exactly what they're going to get paid every moment of every day based on the performance of their unit. It also incentivizes them to all be salespeople and all be PMs because they're all sort of pulling on the same oar. They get overpaid in good times. They may get underpaid in bad times, but overall they're very well paid people. And Troy's status symbol, I think everybody who works at Kayne Anderson feels that's a status symbol. So that issue is not a big issue to us. The biggest problem we have in developing our people, though, is we get the best and the brightest people come to work for us, but that doesn't mean that they can decide whether to invest in something or not. And our biggest problem is to find those people that can not only report to you all the information on a company, say all the positives and negatives, but to determine whether our positives outweigh the negatives or not. Often you just get told a data dump of everything they know. And that's quite intimidating when you get a Harvard graduate or a Stanford graduate with an MIT background and he tells you everything he knows about a company's name. Well, it becomes worthless. You can't decide whether to invest or not based on that. So we're spending a lot of our time trying to find those people that will club us over the head that we have to invest in the name, and bring those type of people on our staff, and that's what we're working on now.
Steve?
We really haven't had any problems retaining talent, and I think it's probably a function of the job market more than anything. We really haven't had any senior departures on our team since the inceptions of the strategies in the late 90s. So keeping the talent there and the top people around has not been an issue for us at all. What we are finding is that the pool available to us out there in terms of hiring is the best it's been in years. Particularly in the quant space, I mean, there's been a number of layoffs, like BGI, for example, in San Francisco, and our HR department has probably more resumes on their desk than they've ever had before. And about, 6-9 months ago, we had an opening for an analyst role, and we probably interviewed, 8 or 10 people, and I mean, it was difficult to decide which one to hire. I mean, out of those 8 or 10 people, probably 4 or 5 were really, really solid. And that hasn't happened before. I mean, usually it's just the opposite problem. You get several people in and you're really not happy with any of them. So this is a huge opportunity to sort of build up an investment management business because the available talent out there is bigger than it's been in years.
I want to go back to what Bob said and echo that. That's getting people to make a decision is one of the most challenging factors that I have to deal with. I can't count the number of times I'll get an email from a very smart, capable person identifying an issue, and the email, see below. So what do you propose? What do you recommend? I mean, sometimes you want to email back, I see it. What's the value add? And I think the paradox is when times get tougher, when decisions become more difficult, and I think we've all had to make difficult decisions over the last 18 months, people become less willing, or there's this tendency on the part of some people to become less willing to go out on a limb and make a decision. And that's, I think, when you absolutely need the best decision making, is when it's toughest to make a decision.
So we only have a few minutes left, and I want to leave a couple minutes for questions from the audience. So if I could, starting at the end, Steve, with you, I'd like to ask you each sort of what you view as the opportunities now from your perspective in the market. Just broadly, where are the attractive areas? How optimistic are you? And then we'll open it up to the audience for a few minutes.
Well, I think in terms of most quantitative firms are largely value investors. We tend to do it in a little bit different way than maybe people are used to thinking about it. But this is probably a great time for value-based strategies, and we've already seen some evidence that valuation type factors are starting to work again, particularly this year. And usually, and this is the paradox that Steve was describing earlier, is that the best times to invest are usually the hardest times to get the assets, and this is one of those times, although I do feel like it's changing a little bit. Value-based strategies, sort of typical Graham and Dodd type strategies where you buy distressed companies, tend to really come in favor in times of macroeconomic growth, stable interest rates, modest inflation, and while we're probably likely to see some inflation down the road, I would not expect to see it in the near future. And I think this is one of those times. I mean, the economy is clearly turning around, corporate earnings are clearly rebounding, and interest rates are at historically very low levels. So I think this is a great time to invest in value type strategies, and the challenge is convincing people that this is a great time, because people, again, they look at what's happened recently and they're so fearful that that's going to be the future. But my expectation is that this is really an ideal time for the space.
Bob, a primary thought there?
We don't believe in investing in companies that don't know that we're investing in them, that don't know Rick Kayne's name, don't know my name. So we don't do anything like what Steve does. We don't invest in General Electric or anything like that. We have to believe that when we put capital in a company, the company's going to be better off for our investment. And an example, we do student housing. We do mezzanine investing. We do MLP investing, and we're on the boards of a bunch of them. So we love all those spaces, or we wouldn't be in them. They're all cash flow oriented. They're all high yielding. They're all expecting 20-25% returns. So that's what we do.
I'll answer the question from a different perspective. I'm not on the investment side. It's not what I do. What I see is the opportunity set is I think the industry is, my view is there's going to be a bit of consolidation. I think now's a great time for a management firm to reposition itself to gain market share. I think there's quite a bit of rubble out there, and I think sifting through it is going to be a little bit difficult, but I think that our firm's view is that there are a number of people out there who have the talent and the ability to produce compelling returns, but the barriers to entry have been raised and there's less competition out there. So we think now is a great time to gain market share for the management firm.
I'm a distressed guy, and the distressed mortgage-backed securities market is just a bond picker's dream. It's incredibly complicated, really idiosyncratic. The term toxic is always used before it. Whenever you hear the term toxic, that's always a really interesting thing to take a look at, because that means there's a lot of revulsion and fear often create a lot of value opportunity.